there, everybody. Welcome back to the InvestTalk Market Wrap-Up. Today is Friday, January 10th, 2025. So let's talk about the market today. U.S. stocks ended lower, a bit off their worst levels, registering another weekly decline coming off the back of last week's decline. The Dow down 163 basis points at 1.63%. The S&P 500 down 1.54%. NASDAQ down 163, and the Russell 2000 leading the way downward, down at 2.22%. Small caps really under pressure today on the back of the rate backup, semis, growth software, China tech hardware, media. Some of the underperformers today, outperformers, included drugstores, airlines, social media names on the back of what could be the TikTok ban implemented on July 19th, as well as some staple retailers and some energy names. Treasuries were under some pressure with yields coming in higher across the curve. Dollar index up 50 basis points, gold settled down 90 basis points, and crude oil ended up 3.6%, rising on the news of additional sanctions against Russia. Overall, I'd say the stock sell-off was driven by some big upside surprise for the December growth in payrolls, that is, adding more support to the Fed's potential pause headed into next year and putting treasuries under some further pressure. Taking a look at how the market is digesting that. The market's now pricing in less than 30 basis points of cuts for 2025. And the first rate cut is now not supposed to happen until October. And this comes on the back of really higher global rate backups overall, which continues to be flagged as an overhang on continued risk sentiment, particularly with fiscal dynamics changing heading into Trump 2.0. Headline volatility surrounding those policies, another area of scrutiny with tariffs and taxes among the most notable issues there. Other bearish talking points for the week revolve around weak market breadth, market concentration, and stretch valuations, as well as some headwinds for earnings per share on the back of a strong dollar. In other news, University of Michigan consumer sentiment headline printed in line with the consensus, while current conditions highest since March, though the expectations index is actually the worst it's been since July. On the inflation front, one-year inflation expectations jumped 50 basis points to 3.3%, tied for the highest since November of 2023, while the long-term expectation on the 5 and 10-year up 30 basis points to 3.3%, the highest it's been since June of 2008. Overall, looks like the jobs data, not a real sign of overheating. The wage growth kind of remains consistent with what we'd see in the 2% inflation area. Looking forward to being back with you more next week.